Hello, my dear family and friends, and thank you for being with me watching this video number 6. This is really important video. We're going to talk about entries, when to get into a trade or investments, mostly in this video. In the next video, we'll talk more about the exits. If market goes your way, when is a good time to exit for profit? If market goes against you, when is a good time to exit for a loss? And the key to understanding this whole topic is understand that the market waves, they don't go straight up or down, but right on the waves. We're going to talk about that a little bit more. And that also brings us the topic of support and resistance. They go so far high and then they come down, and then they come down so far they go back up. And so the key to understanding, of course, the financial market is education. And this is what we're doing here. These are educational videos, and they're not intended to provide you with any investment advice, but rather to educate you about how the market works. And of course, financial markets are risky, and please take a moment and read this legal notice. And knowing that you could lose money, in some cases people lose all of their investments or the money they have in the stock market or any financial markets for that matter. And the reason for that is mostly because lack of education and emotional trading. So by studying and learning and realizing that there is a learning curve involved with anything that we study. But what we're trying to do here is that to bring all that education simplified, make it practical, and so we can cut down on that learning curve. So my feel is that if you take about half an hour every day and study, you should be able to become successful trading. At least we encourage you to start with paper trading, so you have about 70% success rate. And then if you want to start trading with real money, then we encourage you to start very small. And so so you can experience emotional trading, and hopefully then by this time you have created your own personalized successful trading plan that you can put into practice. And so please keep in mind that the education that we have is based on what's happened to the market in the past. And using that, then, of course, we try to make our trades based on what happened in the future, what we may expect to happen, or I should say what happened in the past. Our expectation is that similar things may happen in the future. But keep in mind that market can do anything at any time. And that's why it's so important to have stop losses. If market goes against us, we can get out on a timely manner. We always want to make those stop losses small enough that doesn't hurt us. And on the other hand, we want to make sure we get the most gain from our entries if the market goes our way. So let's start. And the first thing we want to understand is that market, it doesn't go straight up, doesn't go straight down, right? And it waves. And basically it goes up or comes down. Those are the two things a market can do. And think about a market like an auction place. In an auction, you may have a handful of people bidding on a item, could be an antique car or a painting or what have you. And because if there are people bidding higher and higher, the price may keep on going higher, even though there might be just a few people. Or in an auction, maybe there are a million people. They are bidding from all over the place. Still, market can go higher or market can lower. So that's one thing to keep in mind. Now, when it comes to trading, we do want to trade with the stocks that there are at least on average a million buy and sell happening throughout the day. The volume called is at least on average 1 million. That way we know the price is moving based on a good large number of people interested in buying and selling. So that's one thing we want to keep in mind. The other thing that we keep emphasizing is that to have a trading plan, and professionals basically are going to trade with a trading plan. And there are basically two types of buyers and sellers in the marketplace at any time. Some of them are professional people with a lot of money, like mutual fund companies, and some of them are retailers. Now, some retailers are pretty good and have a good amount of money as well, but for the most part, retailers are trading out of emotions. They're chasing the market, they get in the wrong place, they get out of the wrong place, and that's what we want to change. Now then, so what we understand then, as the more people want to buy, market goes up, but then market goes to a certain place that people think, okay, that price is getting too expensive. And then some people start taking profits. Also keep in mind, let's say mutual fund company comes and wants to buy a few million shares of a stock. They're not going to buy everything one time. They're going to, place a few thousand trades throughout the day. And then once it gets to a place that it's getting expensive, they don't want to buy that expensive, they may even sell some to bring the price lower. And also, retailers also may want to be taking profits. So that's what brings the market lower. Now, how low it comes down, of course, depends again who is selling. If it's just basically retailers, you see that market doesn't come down that much. If professionals coming in, it's possible to bring it even lower, and it may even go further down than here, then bring it up. So you got to be aware of that. And of course, if there are more sellers in the marketplace, the market's coming down. Again, at some point, people think, okay, that's oversold. It's getting too cheap. So they may start buying again here. And again, professionals may be part of that. And again, depends how far this goes. It shows who's really involved in that. Normally, if retailers are selling or buying at this point, then it has what we call, shallow retracement. If there are professionals coming in here and selling, it may have a very deep retracement, even at some point goes the other way. And so then basically markets either goes up or market goes down. And when the market is trying to find a fair market value, that's when you see markets going sideways, and it could happen with the markets going up or markets coming down. So in a sense, you can say there are three ways to the market: up, down, and sideways. But sideways, like I said, is only the time that people trying to find the fair market value. And for that matter, we're going to talk about this. When market goes sideways, that's where we want to enter a trade, because when this going sideways, it's building energy. People trying to decide whether market value is there or not. And if they decide there's more value, then you'll see a lot of buyers come in and market goes up. And the other way too, market can go down. Now, please keep in mind also, there are people, they're professional people, they're trading every day, and they're trying to take your money. And so they know that some people want to enter a trade at this point here when the market goes sideways and they want to get in. So they may have the market go up only to come back down. Or here they can have the market go down only to come back up. So this is something also you're going to learn, and we're going to show you how we enter a trade here. But basically, we've discovered that if you trade just put an order here and get in the market, 70% of time you're going to be successful. Of course, we don't do this with any financial instrument. You've seen us talk about selecting just a handful of good stocks or other financial instruments that have a great history behind them. And so that's how we trade. We only trade with those instruments that we have chosen based on their long-term trend. So then what we want to understand is this whole dynamic even more. And we recognize then at some point, if market is coming down here, is going to go back up. So what is the legal definition of a trend? Now, if you're talking about an uptrend, market's coming down here, it has to make a higher high. So if the low point is here, it has to make a higher high here. Then we'll find that again, people taking profits, it's coming down here, and we want this low point be higher than this high point. And then, like we said, market is going to go back up, break through here, go to another high point. So once we have this dynamic, here we call this A point, we call this B point, and this C point, and this here D point. So once we have this dynamic occur, that means we create a higher high and higher lows, and we create A, B, C, D, we have a higher high. So again, let's say here is my A point. It goes up a certain point, reaches B, it comes down, make a higher low. So this is higher than this high. In this here low here is higher than this low here. And then it goes back here, makes a higher high. Even if it's just a little bit higher, it still created an uptrend. So as long as it closes above the B point, here we have a higher high. And the opposite becomes lower low, become downtrend. So here we create a lower low and then lower high. So let's say we are at this point A, comes to this point B. So this is lower than this low here. Then it comes here. This is a higher than this point. This is a lower high. Then it comes and closes below this point here. That's our D. So we have A, B, C, D again. And so this is really important. I hope you take the time to really look at charts. You'll see this happens over and over again. Of course, there are times you see market moves really fast, as a very shallow retracement moves very fast. That's not normal. There's some news or something's going on, and that trend cannot last for long, and it's going to drop at some point. And the same thing going down fast is going to come back up at some point. But normally you see a market moves like a 40, 45 degrees angle, and that's what we're looking for. We want a market that has a nice strong trend behind it and is going up. And what we are looking for is create an A and B, and then C, we come in here to look for a trade, or we come here. Once it breaks the B, we look for a trade, and it takes us to a certain point D. And of course, if market turns around, we want to get out maximum at this point here. Or we may even get out sooner. At this point, market comes down, goes back up, comes down, breaks this point here. Now we have a downward A, B, C, D, and we can exit here, because here telling us the direction has changed, and we may not have to wait till it comes to this point, so we can get out sooner. But this is our last line of defense. If this breaks, we're definitely out there. But if you feel that a market is going to go further down, then you can get out at this point as well. Now, what we are talking about then is at any time frames, we'll see how markets move in the same way. So remember, we talk about we're going to have three charts. We're going to have monthly, weekly, and daily. So on the monthly, we're looking for a nice trend. On the weekly, we look for these retracements. And we talk about them become 1 or 2 standard deviation. And those are where market becomes oversold. And then we look to get in the trade then and go as far as we can up to the D point. And sometimes we may even let it go further, higher and higher, and we'll discuss how we do that. And so then our trigger point is D, but our setup is on weekly, and then on a small time frame, in this case on the daily, we look to enter a trade and exit a trade. And so then, like I said, we take only a few strong markets. We look for this retracement. This trend is on a monthly, retracements on the weekly, and then our trigger point is on the daily, so we can have a faster getting inside the trade and don't wait for the weekly or monthly to change around. Okay, and so then we're going to talk about entries now. There are 3 ways we can enter a market. And we're going to go over them. But the main thing is that, like I said, is when market goes sideways, and we're going to enter that trade. But first, remember, market is going down. So here on the weekly, we come into 1 and 2 standard deviation here. Now, when the market comes down, sometimes go very quickly up, sometimes goes sideways here, and then goes back down or goes back up. So here, some people love to enter a trade at this point. They want to get as much as they can from this change of trend if the market goes back up. But of course, this becomes also more aggressive. Now, at one point, we're going to discuss more candlesticks pattern, Japanese candlestick patterns. And normally, the earliest you want to enter a trade at this point here is to have a good bullish candlesticks pattern here. And so at this point, then, we're not going to trade here. The next thing is that at some point, then market goes up. And this could be, a few days, or it could even go longer. It could be a short going up, could be a long extension here. But at some point, then it's going to come back down. We talk about how at B, people start taking profits, and it start going to have retracement here. So this point C here, it can also become an attractive place to enter a trade. And this is more moderate, it's not as aggressive as this here. And also if you trade here, then you exit at a point here if it goes against you. So you're taking a smaller risk here. Of course, we always measure this risk before we enter a trade to make sure it fits our risk tolerance that we discussed in the past. And so this is another trade that we may discuss sometimes in the future. But again, we're not going to use this at this time. The next one is that market comes and breaks the B. Now, let me say this. Once you have A, once you have B, market can do anything it wants during this time. Sometimes it comes a little short amount and then goes right back up. Sometimes goes further down and goes back up. And sometimes could take a long time up and down here. And that's why when you see the market going sideways, especially a long time, then it's going to break out either up or down. And so we want to trade it here. As soon as we have a closed candle outside of B here, some people like to even put a entry right at that position, but I'd like to see the candle actually here closes. And then if the next day market is going above it, then we enter a trade. And we want to go as far as D that will take us. And so then also the same thing, market going down. So if you see market has been going up a long time, and remember this is on the monthly, and then we'll see on the weekly, we have this retracement down here. Well, I'm sorry, I should talk about, we're talking about here. And again, this is more advanced. This is we can do this with futures, with forex, or with options. But I just want to mention it to you so you have an idea for it till we get to that point. So if the market has been going up, then at this point here, market is going to come down. So again, this is on the weekly. Market has come up here, 1 and 2 standard deviation. And again, if you have a bearish candle position here, some people like to take this trade, or you come down here to B, wait for it to go to C. Some people like to trade from here down, but we're going to wait till it comes down here, closes below number 3, and then if the next day continue going down, we want to get into this trade. And so this is again the opposite of this one here. And so these are the 3 entries. Again, we're going to basically work with the third one, which is a breaking out of the sideways. We call them the breakout or momentum trade. And we find that 70% of the time this is successful. And so like this is a actual chart, and you can see market has been going up, then here start going sideways. So this here we call the resistance, because it got to a point here, it could not break any higher. And like I said, this could be shallow, could be deep. It could take just 2-3 days, could take days, weeks, or months for that matter. But at some point, it's going to break out either up or down. And normally, the way we trade, the monthly is pretty strong. We have a retracement on the week. On the weekly, we may see some sideways on the day, and then we're going to take the trade to go in the same direction of the monthly. And so then we just really need to pay attention to the charts and see this dynamic. You'll see it happen over and over again. And this is how we trade. And after a while, you get comfortable with it. You'll see it's really a simple thing to recognize and trade with. And so then we're going to look at the charts. And please feel free if you have any questions, email me to swingtrade swingtrade financial freedom@gmail.com. And please keep in mind, Sunday nights, 8 to 9 p.m., I do offer a free online live webinar. So once you study these videos, please feel free, come online, send me an email. I'll send you the link for it for that week. And you can ask me any questions you like, and we can go over any topic that we've covered in these videos up to that point. And so then now we're going to go on live charts. Okay, so now we're looking at some charts. We're going to start with Apple. And as you can see, this is a simulated trading, paper trading. And so I encourage you, if you want to practice, please paper trade. I'm using Thinkorswim. It's a great software. I'm not at all in any way associated with them, but it's a great software for everything we want to trade. So when we look at Apple, here you can see this is the 20-year history. It's very nicely going up, and you can see there are times of retracements. And every time it comes back to that retracement, it breaks, it goes higher. Back down here, as you can see, goes higher. Now, sometimes retracement is shallow, sometimes a little bit deeper. Now, on the weekly, as you can see, market has come down here now, and it started going up. Now here, for example, we had a shallow retracement. Now it's heading up. But we only want to trade when we find the stock has come down to 1 or 2 standard deviation. That means it's become oversold here. So right now, we're only looking for stocks at this point here. Now, at this point, if you had seen the stocks here, you can see market was down, and then you see that we had a shallow retracement here. This is A, B, C, and then it took off to D. Now this low point becomes our new A, goes up to B, comes down here to C, as you can see here now. Was going sideways for a couple of weeks or so. Then he breaks this and goes to D. And then we start down here again. The lowest point becomes our A. This D becomes our B. You see market retraced. It went sideways for a few days, and it broke here, and now it's going higher. So this is what happened. This is what we look for. But of course, this is after what's happened, but we look for something at this point here. So let's see, based on the stocks that we have, what else we find. The next stock I can look at is ABT, Abbott. And if I open the weekly, you can see it's come down here now to 1 standard deviation. And that's what we're looking for. Now, if you look at the monthly, again, you'll see we have a great trend. Now, on monthly, we've reached 2 standard deviation. The highest point was $80.74, and you see we had a very bearish month. So this has come down here. Now, is this going to go back up, or is it going to go further down? Okay. Now, we're going to discuss this even more in the future, but then we come down here to the daily, and then what do we wait for here? Well, it's come down here. It had a big drop here, and then this last day on Thursday, as you can see, has a small green here. This is indecision. So what we're waiting for here then To create an A here, that means it turns around. We wait for it to get a certain point we call B, and then come down to a point we call C. Then we want it to go break and close above here, then we want to get into this trend. Okay? Because once we have A, B, C here, even though close a little bit above B, we have A, B, C, D, and of course our main D is up here, that's our target, but a small d shows that I've closed above this point B here. Now, the turnaround, when it happens, we want at least 2 candles on each side. So this A would not be created till we have at least another candle here that is higher than this low point here. We call this then a fractal, low fractal, or a low point. And of course on this side we do have also more than 2 candles on each side. And then when it goes back up, we want to go till it comes down at least 2 candles lower than this high point here. So that becomes a high point or a high fractal. And then when it turns around, that becomes C. Now, as we have mentioned, this could go up and come down and make it lower C, but the C that ultimately happens is the one it brings it back up, breaks this B point here, and then creates a small d above this B point, and we want to go all the way to the big D. Now, there is a indicator you can actually put on your charts to show you these fractals or these high and low points. And the way we find that is we're going to go where it says the studies here, for example. See, here it says the studies. You click on that, and then you go to Add Study. You come to All Studies here. You come all the way down to WZ, and then you go right. It says Williams Fractal. You see that here? And you click on that. Now, you can see I have a low fractal here, a high fractal here, and when you see that, it shows that there is 2 candles on each side. Of course, could be a weekly, a monthly, or smaller time frames. Doesn't matter. As long as you have 2 candles on each side, this becomes a fractal. So here, for example, you can see we have a fractal here, fractal there. It's been going sideways through here. Look at here for how many weeks. This went sideways till finally broke here. Now, one thing you want to notice here right now, see here? You don't have a fractal. Why? Because this was lower than here, but this other one is higher than this point. Okay? Now, you're going to should get a fractal at this point here. For some reason, it's not showing it. But then sometimes if they're very close to each other, may not show the fractal. But then you realize this is a high point here. It's got 2 candles on each side. So this should be a fractal. So that's the only thing sometimes you don't see a fractal. But by paying attention, then you can see those fractals happening. So I'm going to go put the fractal also on the monthly. So again, I come down here, Add Study. I come to All Studies, bring it all the way down to WZ, come to right, come down to William Fractal. Again, you see I have fractals here. I'm going to do the same thing also with the daily. I like to see it on all my charts. Again, Add Study, All Studies, come down below WZ, and we're going to go to William Fractal. Okay? So again, now we made these changes, we can save this. We can save grid as, and we call this class daily, weekly, monthly with standard deviation. So now we have it here. All right, so let's go to the next stock. These are, by the way, you want to write them down. These are the handful of stocks that we're going to be using. We'll go over them, every week if they see a major change. Here, Amazon, you see, went up again, came down, and here you can see markets being going up. So then, now, again, it came at this point here, so we're way up there, so we're not looking for that. But again, as a practice, if you look at the daily, and this is what we look for here. So this was a low point here. As you can see, we call this A, there's at least 2 candles on each side. It had 3 candles going up. Then it comes back and makes 1, 2, 3 candles down, make a low fractal. Then he goes sideways here. Then he breaks it. Now here, it did close about here, but as you can see, what we want to do, if it goes higher at this point, the high point of last time, we want to get in. In this case, we did not get in, and we'll see it comes down. So now this becomes the new B here. This is our new C. It comes and closes above it. Next day broke above this, and now we are in. It goes up here, comes down, and you can see the same trend back and forth. We're going to have that. So we're looking for something down here to start going higher. The next one, Costco. Let's look at Costco. And again, if you look at monthly, you see very nicely on a monthly. And again, you see the same movements also on the monthly as well. See here? The same movements. And of course, here is already gone up, so we're not going to look for it. But again, as a practice, we're going to look at the daily. And you can see here we have market has been coming down. We created a low point here. It went up, made a fractal, came down to this point, went sideways. And then here it comes, and you can see how strong this energy was, just broke through it. I mean, this happened after hours and before hours. And it could have been earnings or something here. But we don't trade around earnings, so remember that. But it closed here. And so then we can get in the trade at this point here because it went higher. And again, you see it's doing the same thing. Now, we're at this point here. It may go higher, but normally we don't want to get in the trade at this point. We want to get a trade once on a weekly we have 1 or 2 minus standard deviations. All right, let's see if we can find something else. Let's, for example, MDT. So here you can see on a monthly, we have a nice, it went up all the way to 1.5 standard deviation. Monthly is coming down. And you can also see on monthly it's creating the same ABCD. You notice this? Right here. So here, it created a high point here, came down here. We have 2 candles on each side, create a low point. Here became to C. Now it's coming down. So it's possible it's going to break and go further down. And so, but it doesn't happen one time. It goes like this. So now on the weekly, we've come down at this point here. We are minus 2 standard deviation. So let's see what it looks like. All right. Now, this is important also to recognize. See, before it came down here, went up. The last time it closed here, but it went this far. And then now we're at the same place. So this is what we call support. When market comes back to the same area, it's going to either break it and go further down, or it's going to come back up, goes higher. So if he cannot break it, this becomes a support. And think about a support resistance, like chopping a tree. So this was the first time here. This is the second time. It's very difficult for it to break through it. The third time also can be very difficult for it to break through. But imagine you have a tree and you have an axe, start chopping the tree. The more you hit it, and the more piece of wood you're taking away from it, at some point it's going to break. But the first and second time when it comes to this point, there's a good chance this may go higher. So now let's look at the daily. See, now we're over 2 standard deviation on a daily. We are 2 standard deviation on the weekly. But again, we're not going to buy here. Some people say, oh, it's oversold, let's buy it. Yeah, it may go back up, but also can go against you. And we talk about this in one of our avoiding the 6 common mistakes. So we're going to wait here till this goes up, create an A, create a B, come back down. We'll wait for it till it comes and break B. This is our A. Then we have our C down here. Once it closes above here, that's our small d. Then we want to take it to go to the big D. And then Next video, we're going to discuss about how to find this D. But today, we want to understand our entry point. And we're going to wait for it to create an uptrend. So uptrend is that it creates a higher high than this point here. It creates a higher low than this. Then it creates a higher point than this point here. Now we have an uptrend, and that's where we want to get into a trade and go forward. Now, of course, if it goes against us, then we're going to get out. We're going to get out either here, or let's do this again so it becomes clear. So market goes up, comes down, goes up here. Now, we're getting at this point here, and we want to go higher. But if you start coming back down, so it's a good chance here it's going to make an A here, it's going to make a B here, go back up, make a C. When it comes down and breaks this, we're going to get out. Okay? So this could be higher than this point, and definitely could be higher than this point. But if this comes down here, this comes down here, then we're going to get out at this point. Okay? And definitely at this point if you still hang in there. And so we're going to discuss the targets and exit points more in the next videos. But for today, I just want to get a feel that we're only going to enter a trade once he makes a B point here, and then he comes and breaks that B point, closes above that B point, and then next day, if you start going higher, we're going to get into a trade. So thank you very much, and look forward to hearing from you. Please, if you learn from this video, share them with your friends and family. Everybody really needs to understand how the market works. Everybody needs to deal with their finances and investments and trading. So I hope this makes it simplified and practical to be able to have really successful trades. Thank you, and have a wonderful week.